Stop everything you're doing right now. This is not just another headline. It has a seismic shift in the global financial landscape that few saw coming. It is Wednesday, January 24th, 2026. And during the height of the Trump administration's trade war, Wall Street's biggest players BlackRock, JP Morgan, and Goldman Sachs quietly moved a staggering $1.4 trillion in assets into China. Yes, while tariffs were escalating and political tensions were at an all-time high, these financial giants were doubling down on China's markets, betting on a future that defied the chaos. This move is not just about money, it's about power, influence, and positioning in a rapidly changing world order. The decision to shift such an enormous amount of capital into China during a trade war sends a clear message. The global financial center of gravity is shifting east, and those who ignore this trend risk being left behind. The urgency is real. Understanding why these titans made this bold move and what it means for investors worldwide is critical. The clock is ticking and the financial world is pivoting. Will you be ready when the dust settles? The U.S.-China trade war officially began in early 2018 when the Trump administration imposed tariffs on billions of dollars worth of Chinese goods, aiming to address what it described as unfair trade practices, intellectual property theft, and the massive U.S. trade deficit with China. This marked a significant escalation in economic tensions between the world's two largest economies. Key events included multiple rounds of tariff increases on both sides, with the U.S. targeting sectors like technology, manufacturing, and agriculture, while China retaliated with tariffs on American goods such as soybeans and automobiles. The trade war created uncertainty and volatility in global markets, disrupting supply chains and raising costs for businesses and consumers worldwide. Investor sentiment during this period was marked by caution and fear. Stock markets experienced sharp swings as each new tariff announcement or negotiation update sent ripples through global financial centers. Many investors feared a prolonged conflict that could slow global economic growth and trigger a recession. Despite the escalating tensions, China continued to open its markets and implement reforms to attract foreign investment. Meanwhile, major financial institutions began reassessing their exposure to U.S.-China relations, seeking ways to hedge risks and capitalize on emerging opportunities within China's rapidly growing economy. The trade war also accelerated a broader geopolitical shift, prompting investors to reconsider the long-term balance of power and the future of global capital flows. This backdrop set the stage for the surprising and strategic move by BlackRock, JP Morgan, and Goldman Sachs to channel $1.4 trillion into China, a bet on growth and influence amid uncertainty. Understanding this complex context is essential to grasp why these financial giants made such a bold move during one of the most turbulent periods in recent economic history. BlackRock, JP Morgan, and Goldman Sachs are three of the most powerful financial institutions in the world, wielding immense influence over global capital markets. Together, they manage trillions of dollars in assets, shape investment trends, and advise governments and corporations on economic strategy. Their decisions ripple through markets, affecting everything from stock prices to international trade flows. BlackRock is the world's largest asset manager, overseeing over $10 trillion in assets. Known for its data-driven investment strategies and global reach, BlackRock has been a pioneer in expanding into emerging markets, including China. The firm has actively sought to tap into China's growing middle class and expanding financial markets, often partnering with local institutions to navigate regulatory complexities. JP Morgan Chase is a global banking powerhouse with a strong presence in investment banking, asset management, and commercial banking. JP Morgan has long recognized China's strategic importance, establishing joint ventures and expanding its footprint in the country's financial sector. The bank's approach combines deep local knowledge with global expertise, positioning it to capitalize on China's economic transformation. Goldman Sachs is renowned for its investment banking and trading operations. It has been an early mover in China's financial markets, launching investment funds and advisory services tailored to Chinese companies and foreign investors interested in the region. Goldman's strategy emphasizes innovation and leveraging its global network to access unique opportunities in China. Historically, all three firms have viewed China as a critical growth market, gradually increasing their exposure despite geopolitical tensions and regulatory hurdles. Their investments span equities, bonds, private equity, and infrastructure projects, reflecting a long-term commitment to the region. Understanding the scale and sophistication of these institutions helps explain why their decision to move $1.4 trillion into China during the trade war was not a reckless gamble, but a calculated strategic play with profound implications for global finance. During the height of the Trump administration's trade war, BlackRock, JP Morgan, and Goldman Sachs orchestrated a massive and strategic shift of approximately $1.4 trillion in assets into China's financial markets. This move was not a simple portfolio adjustment, but a calculated repositioning aimed at capitalizing on China's long-term growth potential despite escalating geopolitical tensions. The scale of this asset migration is staggering. To put it in perspective, $1.4 trillion represents a significant portion of these firms' global assets under management, reflecting a deep conviction in China's market resilience and future prospects. This capital inflow spanned multiple asset classes, including equities, fixed income, private equity, and infrastructure investments. In the equity markets, these firms increased their stakes in Chinese technology giants, consumer brands, and financial institutions. Sectors such as e-commerce, fintech, and renewable energy were particularly attractive due to China's rapid digital transformation and government support for green initiatives. By investing in these high-growth areas, the firms positioned themselves to benefit from China's expanding middle class and technological innovation. On the fixed income side, the asset shift included substantial purchases of Chinese government bonds and corporate debt. China's bond market has grown rapidly and offers diversification benefits, attractive yields, and increasing accessibility to foreign investors. These investments also serve as a hedge against volatility in other global markets. Private equity and infrastructure investments formed another critical component. The firms funneled capital into Chinese startups, real estate developments, and large-scale infrastructure projects aligned with China's Belt and Road Initiative. These long-term investments reflect confidence in China's economic planning and urbanization trends. This asset shift was facilitated by regulatory reforms in China, such as the easing of foreign ownership limits and the inclusion of Chinese securities in global indices, which made it easier and more attractive for foreign investors to enter the market. In summary, the $1.4 trillion move was a diversified, multi-sector investment surge that underscored the strategic importance of China to these financial giants. It was a bold bet on growth, innovation, and geopolitical positioning during one of the most turbulent periods in recent economic history. The decision by BlackRock, JP Morgan, and Goldman Sachs to move $1.4 trillion into China during the Trump trade war was driven by a combination of strategic factors that go beyond short-term market fluctuations. These financial giants recognized that China's unique position in the global economy offered compelling reasons to deepen their exposure despite escalating geopolitical tensions. Diversification was a primary motivation. With global markets increasingly interconnected and volatile, spreading investments across different regions and asset classes reduces risk. China's rapidly growing economy and expanding financial markets provide a valuable counterbalance to Western markets, which faced uncertainty due to trade disputes, political instability, and slowing growth. By allocating significant capital to China, these firms enhanced portfolio resilience and tapped into a market less correlated with traditional Western assets. The growth potential of China's economy remains unparalleled. Despite trade tensions, China's middle class continues to expand, driving consumption and innovation. Sectors like technology, renewable energy, healthcare, and consumer goods are booming, supported by government policies aimed at fostering sustainable development and technological leadership. These growth drivers offer attractive long-term returns that are difficult to find elsewhere. Another key reason was hedging against U.S.-China tensions. The trade war introduced significant uncertainty, but these firms anticipated that economic decoupling would be gradual and incomplete. By increasing their presence in China, they positioned themselves to benefit regardless of how the geopolitical landscape evolved. This hedge protects against potential disruptions in global supply chains and capital flows, ensuring access to one of the world's largest and most dynamic markets. Finally, regulatory changes in China played a crucial role. Over recent years, China has progressively opened its financial markets to foreign investors by easing ownership restrictions, improving transparency, and including Chinese securities in major global indices. These reforms lowered barriers to entry and increased the attractiveness of Chinese assets, encouraging large-scale investment from global financial institutions. In essence, the $1.4 trillion move was a calculated, multifaceted strategy combining risk management, growth capture, geopolitical hedging, and regulatory opportunity, a bold bet on China's central role in the future of global finance. The massive $1.4 trillion asset shift by BlackRock, JP Morgan, and Goldman Sachs into China during the Trump trade war had profound implications for U.S.-China relations, global capital flows, and overall market dynamics. From a geopolitical perspective, this move sent a complex message. On one hand, it underscored the deep economic interdependence between the U.S. and China, even amid escalating trade tensions and political rhetoric. While governments clashed over tariffs and strategic competition, Wall Street's biggest players were doubling down on China's financial markets, signaling confidence in the country's long-term economic trajectory. This divergence between political conflict and financial cooperation highlighted the nuanced reality that economic ties often transcend diplomatic disputes. In terms of global capital flows, the shift accelerated the redirection of investment dollars toward Asia, particularly China. This influx helped solidify China's position as a key destination for foreign capital, boosting liquidity and market depth in Chinese equities, bonds and private assets. It also contributed to the gradual rebalancing of global financial markets, reducing Western dominance and increasing China's influence in setting market trends and valuations. The move also influenced market dynamics by increasing competition for Chinese assets, driving valuations higher and encouraging further regulatory reforms to attract foreign investors. It pressured other global investors to reconsider their exposure to China, sparking a broader trend of portfolio diversification toward emerging markets. Additionally, the increased capital inflow supported China's economic resilience during a period of external pressure, helping stabilize markets and maintain growth momentum. However, this capital shift also raised concerns in the U.S. about financial dependence on China and the potential risks of geopolitical escalation affecting investments. It sparked debates over national security, economic sovereignty, and the role of global finance in geopolitical strategy. In summary, the $1.4 trillion move was a catalyst that reshaped U.S.-China economic relations, redirected global capital flows, and altered market dynamics, reflecting the complex interplay between finance and geopolitics in the 21st century. The massive $1.4 trillion asset shift into China by BlackRock, JP Morgan, and Goldman Sachs carries significant implications for both retail and institutional investors around the world. Understanding these risks and opportunities is crucial for navigating the evolving global financial landscape. For retail investors, this move highlights the growing importance of China as a key driver of global economic growth and investment returns. China's expanding middle class, technological innovation, and government-backed initiatives like renewable energy and infrastructure development offer attractive long-term growth prospects. However, retail investors must also be aware of the risks, including increased market volatility due to geopolitical tensions and regulatory uncertainties within China. Access to Chinese markets has improved but remains complex, requiring careful selection of investment vehicles and trusted intermediaries. Institutional investors face both challenges and opportunities. The influx of capital by major financial firms signals a competitive environment where access to high-quality Chinese assets may become more limited and expensive. Institutions must adapt their strategies to include China-focused funds, joint ventures, and partnerships to maintain exposure. At the same time, the move underscores the need for robust risk management frameworks to navigate regulatory changes, currency fluctuations, and geopolitical risks. Both retail and institutional investors should recognize that the global investment landscape is shifting eastward. Ignoring China's growing influence could mean missing out on substantial returns and diversification benefits. Conversely, blindly investing without understanding the unique risks could lead to significant losses. In summary, the $1.4 trillion move is a wake-up call for investors worldwide to reassess their portfolios, embrace China's opportunities, and prepare for a more complex, interconnected, and geopolitically charged investment environment. The $1.4 trillion asset shift by BlackRock, JP Morgan, and Goldman Sachs into China during the Trump trade war offers several critical lessons for investors and policymakers alike. First, it underscores the resilience and attractiveness of China's financial markets, even amid intense geopolitical conflict. These firms demonstrated that strategic positioning and long-term growth prospects can outweigh short-term political risks. Second, the move highlights the increasing interdependence of global markets. Despite rising tensions, capital flows continue to bridge divides, reflecting the complex reality that economic and financial interests often transcend political disputes. This dynamic creates both opportunities and vulnerabilities, as shifts in geopolitical relations can rapidly impact market sentiment and asset valuations. Looking ahead, this trend of deepening financial integration with China is likely to continue, albeit with greater caution and complexity. Ongoing geopolitical tensions, including trade disputes, technology competition, and national security concerns, will shape investment flows and regulatory environments. Financial institutions may adopt more sophisticated risk management strategies, balancing exposure to China with diversification elsewhere. We can also expect increased scrutiny from governments on foreign investments, particularly in sensitive sectors, potentially leading to tighter regulations and oversight. However, China's commitment to opening its markets and reforming its financial system will continue to attract global capital. In summary, the $1.4 trillion move signals a long-term pivot toward China that will persist despite geopolitical headwinds. Investors who understand and adapt to this evolving landscape will be best positioned to capitalize on the growth opportunities while managing the inherent risks. To recap, the $1.4 trillion asset shift by BlackRock, JP Morgan, and Goldman Sachs into China during the Trump trade war reveals a profound shift in global finance. Despite geopolitical tensions, these financial giants bet heavily on China's growth, signaling the country's rising influence in global markets. This move underscores the importance of diversification, strategic positioning, and understanding the evolving geopolitical risks. The urgency is clear. Investors who ignore China RMS growing role risk, missing out on significant opportunities, and facing unexpected volatility. Navigating this complex landscape requires staying informed, diversifying portfolios, and considering exposure to China's dynamic sectors through trusted channels. Don't be left behind as the financial world pivots east. Act now to adapt your investment strategy and position yourself for the future of global capital flows. Thanks for watching. If you found this breakdown helpful, make sure to like and subscribe for more insights. See you in the next video.